Usually when we talk about a diagnosis or fixing a really serious problem, there is this comforting expectation of precision, you know?
Oh, yeah, like it's engineering or something.
Exactly. It's like engineering. You break your arm, the X-ray shows that like jagged white line fracturing the radius, and the doctor just points a pen at it and says, there it is. That's the break.
Right, it's completely binary. The
Yeah.
bone is either intact or it is fractured.
Yeah.
And because it's so visible, we can apply a really specific mechanical fix to it. We put a cast on it, we wait 6 weeks, and boom, the problem is resolved. I mean, as humans, we just crave that kind of neat categorization in our lives.
We really do. But then you step into the world of behavioral psychology, right?
Yeah.
Specifically inside high-stakes performance environments. And suddenly that X-ray machine is just utterly useless,
Yeah, you're looking at a diagnostic landscape that is completely opaque.
totally opaque.
Yeah.
Because the thing that's broken isn't a bone. And it isn't even like a specific strategy you're employing. It is the lens through which you're viewing reality itself.
Wow, yeah.
And that shattered lens is why 80% of success in any high-stakes environment, but especially the financial markets, is purely psychological.
Which is, frankly, a terrifying concept for a highly analytical person to accept.
Oh, it really is.
Yeah.
So today, we're unpacking exactly why really smart people constantly sabotage themselves. We're doing a deep dive into the core psychological principles of trading, using the source material from Mark Douglas's seminal work, The Disciplined Trader.
Such a good book.
It's incredible. And listen, even if you have never traded a single stock or commodity in your life, you need to hear this. Because the psychological traps we are about to uncover, they apply to literally any area of your life where you have unlimited freedom, unlimited risk, and just a total lack of external structure.
Yeah, and Douglas's work is so foundational here because it completely shifts the paradigm of, what it actually means to be successful.
Right.
Most people just assume that conquering the markets or conquering any highly competitive, unstructured arena is about having the best analytical system.
Like the smartest algorithm.
Exactly. The smartest algorithm, the fastest data feed. You think if you just study harder, if you build a better spreadsheet, you win. But Douglas proposes something radically different.
He argues that you could have a mediocre analytical system, right? Like a totally average grasp of fundamental market data. But if you are in complete psychological control of yourself, you will be profitable.
Yeah, and the reverse is true too.
Right. Conversely, you could have a brilliant, perfectly back-tested, theoretically flawless system. But if you lack psychological control, the market will just systematically destroy you.
Because the market is essentially a mirror reflecting your deepest insecurities.
And, man, to set the stage for how deep those insecurities go, there is a quote in the source material that immediately grabbed me. It's from the ancient Greek tragedy, Medea, by Euripides.
Oh, right. This is a great pull.
Yeah, so just before Medea commits this unthinkable, horrific act of vengeance, she says, I know what evil I'm about to do, but my irrational self is stronger than my resolution.
It is such a chilling line, and it just perfectly encapsulates the dilemma of the modern trader, or, well, really, the modern human operating under pressure.
Exactly. I mean, think about your own life. Think about a time when you knew exactly what you should do. You wrote down a plan, you made a firm resolution. The logical, beneficial path was, like, illuminated right in front of you.
We've all been there.
We all have. But then in the heat of the moment, under pressure, you sat there and watched yourself do the exact opposite.
Yeah, it's almost like an out-of-body experience.
Yes. Your irrational self just grabs the steering wheel and drives you straight off the cliff, and your logical brain is just sitting in the passenger seat screaming.
And what's really fascinating about the trading environment is that it is practically a laboratory that is specifically designed to trigger that irrational self.
So true.
To understand why we self-sabotage so spectacularly in the markets, we have to look backward. We have to examine the environment we were raised in and contrast it with the environment we're trying to operate in as adults.
Right, let's pull that thread. Because we are talking about the ultimate clash of two entirely different universes here. The environment of society versus the environment of the market.
Yeah. So from the moment you are born, you exist within a highly structured cultural and social environment. Our parents, our teachers, our religious institutions, society at large, they all impose strict external boundaries on our behavior.
Right, we're taught the rules of the game before we can even speak.
Exactly. They act as the guardrails on the highway of life.
And those guardrails are enforced using a very specific, deeply ingrained system of rewards and punishments.
Right, absolutely.
If you conform to society's expectations, you're rewarded. You get a gold star in class, you get
Yeah.
praise from your parents, you get a promotion at work, you get social acceptance.
And if you step out of line, you are punished. You're grounded, you're fired, you're ostracized. You're prevented from getting what you want, which causes emotional pain or, historically speaking, even physical pain.
So we learn incredibly early on that our behavior is controlled by the threat of pain from an external force that is infinitely more powerful than we are.
Right, a child cannot overpower their parent.
No. And a lone employee cannot usually overpower a massive corporation. So we learn to function within this rigid structure where someone else is always making the rules and someone else is always enforcing the consequences.
And we willingly trade a portion of our personal power and autonomy to these external forces in exchange for safety, predictability, and social inclusion.
Which makes sense.
Mm.
But that conditioning teaches us a fundamental, but ultimately flawed, lesson about how to manipulate our reality.
Right. It teaches us that if we want to change our situation, we need to acquire the power to manipulate or force changes upon the things outside of us.
Yeah, like if you want a raise, you figure out how to persuade or manipulate your boss. If you want a better grade, you conform to the teacher's specific grading rubric. You learn to navigate the external structure.
But then you decide you want financial independence. You decide to become a trader.
Right.
You open a brokerage account. You fund it with your hard-earned money. You sit down at your computer, you stare at the glowing green and red numbers on the screen, and you are suddenly dropped into an environment that operates on completely alien physics.
Alien physics is the perfect way to describe it. The trading environment is the absolute antithesis of the cultural environment we just described.
Completely.
The market has absolutely no power or control over you. It has zero expectations regarding your behavior. And most terrifyingly, it has absolutely no regard for your welfare.
It doesn't care if you need to pay your mortgage.
Not at all.
It doesn't care if it's your child's birthday. It is an environment of total, unadulterated freedom.
It's like putting on a virtual reality headset and jumping into a sprawling video game, only to realize the developers forgot to program any physics, any walls, or any gravity.
Oh, that's a great analogy.
Right. At first you think, this is incredible. I can go anywhere. I have total freedom of expression. But it only sounds fun until you realize that without gravity or solid ground, you can just fall forever. There's nothing to stop you.
That endless falling is precisely what happens to the majority of people who enter the market. The external constraints that existed in society to stop you from hurting yourself simply do not exist in the financial markets.
No guardrails.
None. The market will not send you a warning email if you decide to put your entire life savings into a single, highly leveraged, incredibly risky position. It doesn't tell you to go to bed when you are exhausted. It doesn't tell you to take a break when you are emotional.
But I'm struggling to accept that freedom is inherently destructive. Like if the market gives us total freedom, shouldn't that be a utopian scenario?
You'd think so, right?
Yeah. As human beings, we constantly rebel against authority.
Yeah.
We crave freedom. Why do we instantly self-destruct the second we don't have a boss or a parent telling us what to do?
We self-destruct because our entire concept of self-worth and expectation is built on an equation that the market completely shatters.
Okay, what equation?
The equation of time, effort, and reward. Think about the physical cultural world. There is almost always a direct correlation between how hard you work, how much time you put in, and the reward you receive.
Right. You work an hourly job. Your physical or mental effort over 40 hours yields a highly predictable paycheck. You dig a ditch, you get paid for the ditch.
Exactly. It's our personal supply and demand formula. Time equals money. Effort equals money.
Yeah.
But the market completely obliterates that equation. In the market, physical effort is entirely irrelevant.
Well, yeah, that's true.
Time spent staring at a screen does not guarantee a return. A trader can make a massive windfall profit, thousands, maybe tens of thousands of dollars in a matter of seconds, and the only energy they expended was a micro decision in their brain and the tiny physical movement of clicking a mouse.
Zero physical effort, just an uncommitted choice.
Zero. And this creates a massive psychological paradox that our brains are just not equipped to handle.
Because we're expecting the ditch-digging reward system.
Exactly. We simply do not have the mental framework to operate in an arena that offers complete freedom of expression, but provides zero external structure or feedback on our effort.
Right.
When you combine unlimited financial possibilities with unlimited financial risk, and you place a human being in that environment who is subconsciously waiting for an external rule or an authority figure to save them, well, you have synthesized the perfect formula for complete emotional and financial disaster.
Which transitions us perfectly into our next massive psychological trap. Because the market requires no physical effort, and because it flashes this constant illusion of instant wealth, we walk into it with wildly inflated expectations.
Oh, completely wildly inflated.
We walk straight into the mirage of easy money and unlimited potential.
And the word illusion cannot be overstated here. Trading looks incredibly easy. You pull up a historical chart of a stock, your brain immediately identifies the absolute bottom of the dip and the absolute peak of the rally.
It's so obvious in hindsight.
Right. Your mind effortlessly traces the line and says, well, if I had just bought right there at the bottom and sold right there at the top, I'd be rich.
Let's break down the mechanics of why that looks so appealing to a beginner. For those listening who don't trade, when we talk about price movement, you'll hear the term ticks. A tick is just the minimum upward or downward movement in the price of a market.
Yeah, just the smallest possible step.
Right. And traders often use leverage or trade contracts. Let's say you're trading a futures contract. A contract is essentially an agreement to buy or sell an asset at a specific price at a specific time. But the key is leverage.
That's where it gets dangerous.
Exactly. You might only need to put up a few $1,000s to control a contract worth $100,000. So if the price moves just a few tiny ticks in your favor, that leverage amplifies those fractions of a cent into hundreds or thousands of dollars of real profit in seconds.
Exactly. You multiply those few historical ticks of movement by a dozen leveraged contracts, and suddenly you are mentally picking out the paint color on your new sports car.
It is intoxicating.
It is, but it brings up the most terrifying characteristic of the market, which is the mathematically unlimited potential for both profit and loss. The market is in a state of perpetual motion. There is no defined beginning to a move, and there is no defined end to it.
And because you never actually know how far prices will travel from any given point, it is incredibly easy to fall into the trap of believing that every single trade you place has the potential to fulfill your wildest dreams of financial independence.
Douglas calls it the big trade mentality. You start viewing every entry as the winning lottery ticket.
Oh, wow.
And when you operate from that deeply emotional, desperate mentality, a very dangerous cognitive shift happens regarding your perception of value. Taking small, consistent profits suddenly starts to feel like a failure.
This brings up one of the most revealing anecdotes from the source material. Mark Douglas, the author, reflects on his early days as a trader in Chicago.
Yeah, the story is wild.
He just moved there. He leased an incredibly expensive apartment on the Gold Coast. He bought a Porsche. And he immediately racked up this immense lifestyle debt. He was operating under extreme, suffocating financial pressure.
Right.
And he admits in the text that he would literally refuse to take profits of $500, $750 on a trade.
Even when his own analytical system was screaming at him that the market move was exhausted, he knew logically that the market had no more upward momentum to give in that moment.
But he wouldn't click sell. Because to him, in his deeply indebted mental state, $500 felt like a paltry, insignificant sum compared to the massive mountain of debt he was staring at.
It wasn't enough to fix his life.
Exactly. He actually wrote that it felt like the market was insulting him by offering such a small amount. He felt he needed a massive home run to fix his life, so he demanded the market give him a home run, completely blinding himself to what the market was actually capable of giving him on that specific day.
Which is a profound textbook illustration of how greed destroys objectivity. What is truly fascinating to analyze here is the psychological root of greed and the concept of, well, how much is enough?
Right.
Because when you operate in an environment with mathematically unlimited potential, the answer to that question is always just a little more. Greed fundamentally stems from a deep-seated belief in scarcity.
Wait, let's test that theory. Greed comes from scarcity.
Yes.
On the surface, that sounds like an oxymoron. Greed is about hoarding massive amounts of wealth, while scarcity is about having nothing. How does one birth the other?
Consider the underlying mechanism. Greed is driven by the subconscious belief that there will never be enough to make you feel truly secure or satisfied. If you felt completely secure, you wouldn't need to hoard.
Okay, I see what you're saying.
Now, combine that internal feeling of perpetual lack with an external environment that constantly, relentlessly teases you with the possibility of unlimited accumulation. The market is always ticking, the numbers are always flashing, it is an endless river of potential. If you are operating from a place of internal scarcity, the appetite of true greed can never be satiated. You will watch a massive winning trade go up $10,000, refuse to take it because it could go to 15, and then you will ride it all the way back down to a devastating loss.
Just because at the absolute top, your scarcity mindset told you it still wasn't enough.
Exactly.
Let me push back on this from a purely mathematical standpoint, though. If the potential of the market is technically unlimited, I mean, a stock theoretically could go up in value indefinitely. Isn't it somewhat logical to aim for massive outsized wins?
Well, sort of.
Like, how does a trader reconcile having massive, ambitious financial goals, but needing to somehow ruthlessly temper their expectations on a minute-by-minute per trade basis?
You reconcile it by forcefully separating the aggregate goal from the individual event. You have to undergo a mental rewiring where you release yourself from the toxic notion that this specific trade right in front of you has to be the one that fixes your life, pays off your Porsche, or proves your intelligence.
Wow.
When you attach your ultimate life goals and your self-worth to a single position, your emotional state completely contaminates your perception. You stop seeing what the market is actually doing, and you only see what you desperately need it to do.
You're projecting.
You are projecting your own financial and emotional needs onto a mechanism that is entirely indifferent to your existence.
And that inability to decide how much is enough, or conversely, the sheer inability to accept when you are wrong and take a necessary loss, brings us to what I consider the most dangerous mechanical difference between the market and traditional risk-taking.
Yeah, this is a big one.
It's the dichotomy of the passive loser versus the active loser.
This distinction is just crucial to understanding market psychology. Let's compare trading to traditional gambling, say, sitting down at a blackjack table in Vegas or placing a bet on a horse race.
Okay.
In traditional gambling, the event has a strictly defined beginning and a strictly defined end.
Right. The dealer shuffles, the cards are dealt, you hit or stand, the hand is resolved, and the dealer either pays you or sweeps your chips away. The event terminates.
Exactly. And your risk is strictly mathematically limited to the exact wager you placed on the felt. You know down to the penny what you can lose before the first card is even flipped. But more importantly, the structural design of the game forces you to be an active loser.
Break that down for me. What makes someone an active loser?
It means that if you lose a hand of blackjack and you want to lose more money, you have to physically reach into your pocket, pull out your wallet, extract more cash, buy more chips, and actively place another physical bet on the table.
Right.
The structure of the game automatically takes you out of the risk pool after every event. If you do absolutely nothing, you lose nothing more. You have to choose to re-engage with risk.
But in the market, there is no automatic termination. The market is not a hand of cards. It's a continuous, violently flowing river. Once you hit the buy button and put on a trade, you have jumped into the river.
Yep, you're in the water.
And the most terrifying, paralyzing part of this environment is that you can become a passive loser.
You don't have to lift a finger to lose everything you own. Once you enter a position, the market can trend against you indefinitely. To stop the hemorrhaging, to stop the loss, you have to actively participate.
You have to act.
You have to forcefully confront your own failure, consciously admit to yourself that your thesis was wrong, and actively hit the sell button to close the trade.
The source material uses a brilliant analogy about crossing the street that I want to expand on. Think about when you were a toddler. You are walking near a busy street, you see something shiny on the other side, and you instinctively step off the curb into traffic.
Right.
What happens? Your parent physically grabs your arm and yanks you back onto the sidewalk. They provide the external physical structure to save your life when your internal judgment fails.
Yes.
But in the market, no one is holding your hand. No one stops you from walking into the middle of the digital highway. And metaphorically, if you wander into the middle of the street and freeze, the market will not swerve. It will just run you over.
Totally.
You are the only one who can command your muscles to pull yourself back to the safety of the sidewalk.
And commanding those muscles to hit the sell button requires confronting immense psychological pain, Because human beings naturally, evolutionarily want to avoid the emotional pain of being wrong or feeling inadequate, the easiest, most frictionless thing to do in a losing trade is to just freeze.
Yeah, do nothing.
To become entirely passive, to stare at the screen and just hope the market miraculously turns around and saves you.
It's like being trapped on a treadmill that never stops. And in fact, is continually speeding up.
Hmm.
If you are sprinting on this treadmill and your legs start to give out, you can't just passively stop moving and expect things to be okay.
Right, you'll go flying.
If you don't actively reach out and smash that giant red emergency stop button, which is the exact equivalent of taking the loss and closing the trade, the treadmill is eventually going to throw you violently backward through the drywall.
That is a visceral image, but mechanically it is entirely accurate. And it forces us to ask the next logical question, which is, why is it so incredibly difficult to just hit the red button?
Why do smart, capable people let the treadmill throw them through the wall?
Exactly. That leads us directly into the deep neuroscience and psychology of fear, pain, and what Douglas calls perceptual distortion.
Because taking that loss requires active participation. It requires looking in the mirror and saying, my analysis was incorrect, I was wrong. And our brains absolutely despise that admission.
Oh, they hate it.
In fact, our brains are so averse to it that it will literally alter our perception of reality to prevent us from feeling that emotional pain.
We have to clearly define what psychological damage means in the context of an unstructured environment. Douglas defines psychological damage as any mental framework that has the potential to generate fear.
Wait, mental framework? Like
Yeah.
a belief system?
Yeah, exactly. A belief system that has the potential to generate fear. And fear is simply the biological and emotional response to any belief that environmental conditions are about to cause us pain.
Right, right.
It doesn't matter if it's the physical pain of a hot stove or the emotional pain of stress, anxiety, disappointment, or betrayal. These painful emotional conditions erupt when our internal expectations violently clash with the reality the external environment is presenting to us.
And as biological organisms, our primary directive is to avoid pain at all costs.
We are hardwired for it at the level of the amygdala. So when the market presents us with data on the screen that blatantly conflicts with what we expect to happen or what we desperately need to happen, our brain immediately deploys heavy mental defenses.
Right.
We resort to denial.
Right.
We rationalize. We justify the bad data.
We've all heard it or, said it ourselves. The market is just taking a breather.
Yeah.
This is just a temporary dip. The big institutional players are just trying to shake out the weak retail hands before the real rally starts.
Every single one of those phrases is a deployment of perceptual distortion. Our mental operating system literally automatically distorts the environmental information coming through our eyes.
Wow.
It shapes it, molds it, and selectively excludes certain critical data points, all to compensate for the painful conflict between our expectations and the market's reality.
Yeah.
We effectively create a hallucinated, shared reality in our own mind that does not actually exist in the market, purely to sedate ourselves against the pain of being wrong.
We gaslight our own brains.
We do. We engage in something called tick-by-tick filtering. Let's break this down. Imagine a market that is slowly but undeniably trending downward. The chart is bleeding red, but you are holding a long position.
Just to clarify for everyone, holding a long position simply means you bought the asset hoping the price goes up. You profit if it rises, you lose money if it falls.
Precisely. You are long, so you desperately want the market to go up. In any given minute of a downward trending market, there might be 40 downward ticks, little drops in price, and maybe 10 upward ticks, little bounces. Out of millions of possible price patterns, your brain's fear center will systematically filter out and exclude the overwhelming downward momentum from your conscious awareness.
Wait, really?
Yes, you literally won't process the 40 down ticks. Instead, your brain will hyper-focus a spotlight on those 10 tiny upward bounces. You will pick and choose the exact microscopic data points that support your desperate hope and ignore the avalanche of data proving you wrong.
Which works as a temporary anesthetic until you hit what Douglas calls the forced awareness moment.
Yes, because perceptual distortion has a breaking point. You can only hallucinate a false reality for so long before the mathematical truth of your account balance overrides your cognitive dissonance.
The numbers don't lie.
Exactly. Eventually, the disparity between your comforting illusion and the market's brutal reality becomes so massive that your mental defenses shatter like glass. The illusion collapses. You look at your net liquidation value, and you are plunged into a state of pure shock. You sit there staring at the screen, bewildered, wondering how things could have gotten so bad so quickly without you noticing. The market forces you to confront reality, and the result is a devastating, often unrecoverable financial loss.
It is intensely tragic because the fear mechanism actually creates the exact outcome the trader's trying to avoid. Let me see if I can map out this irony.
Go for it.
So if you were in a winning trade, the market is going up, you are making money. You are suddenly terrified that the market is going to reverse and take your unrealized profits away.
Right.
So that fear makes you hyper-focus on every tiny, insignificant signal that the market might be turning around.
Yeah.
You get spooked by a shadow and you hit sell, cutting your profits entirely too short.
You acted prematurely because your fear of losing the gain overpowered your objective analysis of the trend.
But if you are in a losing trade, the fear of actually realizing the loss, the agonizing pain of officially being wrong, makes you ignore all the massive, glaring negative signals. You focus only on hope. So you hold on to the toxic asset, you let the loss run and run until it completely destroys your account.
It is the ultimate psychological irony of human performance. The fear of losing is the exact mechanism that guarantees the losses.
Wow.
By focusing all your internal attention on pain avoidance, you systematically exclude from your awareness the actual market information that would indicate valid opportunities or clear dangers. You narrow your field of vision to the object of your fear, and in doing so, you become completely immobilized.
Just frozen.
You know exactly what you should do, just like Medea knew what she was about to do, but when the moment arrives to execute, your irrational self freezes your hand on the mouse.
Okay, I have to stop you here because this is getting deeply existential and honestly a bit bleak.
It is pretty intense.
Are you telling me that human evolution, millions of years of survival instincts, has fundamentally wired us to be terrible at trading? If my own amygdala is automatically hiding crucial data from my conscious mind without my consent, how can I ever trust what I am looking at on the screen? Are we just doomed?
It is a profound, incredibly important question. And the harsh truth is, yes, the evolutionary wiring that kept our ancestors alive on the savanna to the fight, flight, or freeze response designed to protect us from a physical predator is actively, aggressively detrimental in a modern digital environment where the threat is just an abstract blinking number on a piece of glass.
That's wild.
You cannot trust your perception if your perception is contaminated by the fear of pain.
So what is the solution?
The only way to trust what you are looking at is to trade without fear. And the only way to trade without fear is to truly, at a cellular level, accept the risk. You have to undergo a psychological evolution where you reach a state of mind where taking a financial loss does not diminish your internal value as a human being.
Wow. Okay. That is a monumental mental shift. Because right now, for most people, since our brains are desperately trying to avoid the pain of being wrong and feeling inadequate, we don't accept the risk.
No, not at all.
Instead, we develop all these elaborate, sometimes ridiculous behavioral mechanisms to shift the blame away from ourselves.
Right.
Which brings us to the creative ways we avoid accountability.
Right. If you are deeply terrified of being wrong, the most logical defense mechanism your ego can deploy is to make sure that whatever bad thing happens, you have a scapegoat. It can't be your fault if you weren't the one making the decision.
Enter the herd mentality, or what Douglas calls the follow the follower phenomenon.
Exactly. You see this constantly. Historically on the chaotic floors of the exchanges, and today in modern retail trading forums, subreddits, and Discord chat rooms.
Oh yeah, everywhere.
The vast majority of people participating in these markets do not have a defined plan. They are impatient, they are addicted to the dopamine of the action, but they don't actually possess a deep understanding of market mechanics. So, feeling lost in an unstructured environment, they desperately look for an authority figure to give them direction.
Right.
They assume that the screaming crowd in the pit or the loudest, most confident voice posting rocket emojis on a forum must possess some secret knowledge that they lack.
It's the assumption that, look at all these people buying. Millions of people can't possibly be as terrified and clueless as I am. They must have a rock-solid reason for buying right now, so I will just do what they do.
And so they jump on the bandwagon. But here is the catch. If you pull one of those followers aside and ask them to articulate the logical, analytical reason why they just risked $10,000 on that trade, they will stare at you blankly.
Yeah, they have no idea.
They won't have an answer until after the fact, when the group consensus collectively invents a narrative to explain what just happened. By following the crowd, the trader keeps their relationship with the market completely mysterious.
Oh, that's interesting.
If the group makes money, the trader's ego tells them, I was smart to identify and follow the right trend. But if the group loses money, they can blame the market, or they can blame the guru they followed. They maintain the comforting illusion of being a rational actor while completely abdicating the agonizing responsibility of decision-making.
The lengths highly educated, wealthy professionals will go to in order to avoid accountability is genuinely staggering. The source material talks about actual floor traders at the Chicago exchanges, guys, handling massive volume who would intentionally avoid keeping track of their net positions.
Let's contextualize that for the audience.
Sure.
The trading floor before the digital era was a physical pit. Hundreds of people in brightly colored jackets screaming at each other, using frantic hand signals, scribbling trades on little paper cards.
Sounds like chaos.
It was. A trader might execute hundreds of buy and sell contracts a day. A net position is simply the math at the end of the day. If you bought 100 contracts and sold 90, you are net long 10 contracts. You own them, and you are holding that risk overnight.
Which means if the market opens the next morning drastically lower, what we call gapping down, you are instantly going to lose a massive amount of money the second the opening bell rings.
Correct. And Douglas observed that many of these traders would literally refuse to do the basic arithmetic on their cards at the end of the day to see if they were net long or net short.
But why? That sounds suicidal for a risk manager.
Because doing the simple math makes you accountable to reality. If you do the math and you look at the paper and know you are holding a vulnerable net long position overnight and the market gaps down and crushes you the next morning, it is undeniably 100% your fault.
Right.
Your ego has nowhere to hide. But if you intentionally lose track of your position in the chaos and you just go home and pray to the unseen forces of the universe that you magically end up flat or profitable by morning,
then it's out of your hands. It's in the hands of the gods. If you win, you're blessed.
Yeah.
If you lose, it's not your fault. It's just cruel fate.
Exactly.
Which naturally leads a supposedly rational financial professional straight into the arms of primitive superstition. And I have to bring up this anecdote from the source material because it is perfectly absurd, hilarious, and deeply revealing.
The urinal penny.
The urinal penny. Let me set the scene here.
Ok.
Mark Douglas, the author, is working at the Chicago Mercantile Exchange. This is a place where millions, maybe billions of dollars are changing hands daily.
Right.
He walks into the men's bathroom. He steps up to an open urinal. Suddenly, the seasoned floor trader next to him turns, looks absolutely panic-stricken, and yells, "Don't use that one. You can wait for mine. I'll be done in a second."
It's just so funny.
Douglas is totally confused. He looks at the guy, looks at the urinal, and the trader nervously points down into the porcelain. There is a single, solitary copper penny sitting at the bottom of the urinal drain.
A literal 1-cent piece of copper.
And this professional trader, a guy who probably just risked $500,000 in the pit 10 minutes ago, scurries away from the urinal like he is fleeing a live hand grenade.
Unbelievable.
Douglas, thinking the guy is crazy, uses the urinal anyway. Later that day, he mentions the bizarre encounter to a client. The client is horrified that Douglas used the urinal. He looks at him and says, "It's common knowledge on the floor. A penny in the urinal is a terrible omen." It is considered universally terrifying to these masters of the universe.
It is a phenomenal story because it perfectly highlights the psychological trap of the unstructured environment. When you refuse to create a structured trading plan, when you refuse to define your risk, when you refuse to hold yourself accountable to math and logic, you feel entirely powerless.
You're just floating.
You're floating in a void, completely at the mercy of unrestrained impulses and random market movements. The human mind cannot tolerate that level of existential powerlessness. So the ego has to project that power outward onto anything tangible to make sense of the chaos.
Even a penny.
It projects power onto a lucky tie, onto hitting all green lights on the drive to work, or onto a dirty penny in a urinal. It is a desperate coping mechanism for an environment you refuse to take responsibility for.
And Douglas points out that this absolute refusal to plan, this reliance on omens and herd mentality, creates a psychological state of random winning and random losing.
Which I would argue is significantly more psychologically damaging in the long run than simply losing consistently. Let's explain why.
Okay.
If you act purely on impulse, fear, or superstition about a penny, and you happen to win a massive trade, your brain receives a massive dose of dopamine. It feels incredible. You desperately want to repeat that feeling. But because you did not have a defined set of logical conditions that led to the win, you have absolutely no idea how to repeat it.
You don't know what you did right, which means you don't know what you did wrong, which means you don't know how to avoid catastrophe the next time. It's like, imagine taking a grueling final exam in quantum physics, but it's entirely multiple choice, and you know nothing, so you literally just throw darts at the paper to pick A, B, C, or D. Let's say by some statistical miracle you score an A plus scroll.
A total fluke.
Yeah. You walk out of that room, but you don't feel like a genius. You feel incredibly anxious because you know deep in your bones that you have zero actual skill to rely on when the next test comes. You are living in a state of constant, low-level terror because you know your survival is based entirely on random guessing.
That underlying anxiety is the direct byproduct of having no internal structure to protect yourself from the limitless external environment. To cure this anxiety, to shed the superstitions and stop relying on luck, the trader has to cross a massive psychological threshold.
They have to accept one harsh, unyielding universal truth.
Yes.
The market's reality supersedes your beliefs, your ego, and your academic credentials. Always. The market is always right.
To understand this, we have to strip away all the complex charts, the moving averages, the algorithmic bots, and the talking heads on financial news networks.
Right.
We have to ask, what is a market at its most fundamental atomic level?
Right.
It is simply human interaction. It is two traders. One trader believes the asset will go up, so they want to buy. Another trader believes the asset will go down, so they want to sell. When they agree on a specific price and execute the trade, they have made a market.
Okay.
That last posted price, the last tick on the screen, is the absolute, undeniable physical consensus of value at that exact microscopic second in time.
Regardless of how wildly irrational or detached from reality that price seems to be.
Exactly. You could have a PhD in applied mathematics from MIT.
Yep.
You could have spent 6 months locked in a room building the most complex, fundamentally sound corporate valuation model in human history. You could know, objectively, deeply mathematically, that a specific stock is massively undervalued and should be trading at $50 instead of $20. But if two other traders out there in the world are willing to sell it to each other at $19 and they have enough volume, enough sheer financial mass to move the ticker, well, they are right, and your PhD is wrong.
Because right and wrong in the market are not about academic truth. They are not about who has the better spreadsheet. It is entirely about force, the physical force of volume-moving price.
Your academic credentials, your genius-level IQ, your superior reasoning process, they are entirely comically useless if the collective force of the market goes against you. The market does not care about your thesis.
Right.
It doesn't care how hard you worked on your model. The market is never wrong. It just is. As a participant, you eventually have to sit down and ask yourself a very painful question. What is more important to me, being intellectually right or making money?
That's a tough one for smart people.
Because in the unstructured environment of the market, they are very often mutually exclusive.
Okay, I'm going to challenge you on this because I think there are extreme edge cases where the market is demonstrably, objectively wrong.
All right, let's hear it.
Let's look at something like the 2010 flash crash, or a scenario where the market moves entirely based on a completely fabricated rumor. Let's say a fake news report drops on Twitter saying a CEO just died. High-frequency algorithms instantly scrape the headline, panic ensues, human traders follow the algos, and a fundamentally healthy stock crashes 50% in 10 minutes.
Okay, I see where you're going.
The CEO is fine, the rumor is a lie. Isn't the market technically wrong? In that instance, doesn't the intellectual trader who hold on to their long position while the world burns because they know the rumor is fake have the right to stand up and say, I am right, the market is wrong?
That is the ultimate intellectual trap, and it bankrupts brilliant people every single day.
Let's break down your scenario. From an objective long-term valuation standpoint, yes, the rumor was entirely false. The catalyst was a lie. But in that specific 10-minute window, did the price actually drop 50%? Well, yes, the ticker went down.
Did the balance in your brokerage account drop by 50%? Did the exchange issue a margin call demanding more cash because the value of your collateral plummeted?
Yes. The financial pain was real.
Then the market was right. The force applied by the sellers acting on that false rumor was real force. The consequences to your equity are real consequences.
Wow.
If you refuse to respect that force, if you refuse to hit the sell button and protect your capital because you are stubbornly demanding that the market recognize your intellectual superiority and acknowledge the truth, you can easily be liquidated and go completely bankrupt while being 100% correct about the rumor.
That is brutal.
Being intellectually right while financially devastated is the ultimate ego trap. The market's reality is the only reality that pays out.
And when traders fall into that trap, when they get absolutely crushed by a market movement that they fundamentally believe is wrong or unfair, It triggers one of the most destructive psychological spirals possible, which is revenge trading.
Revenge trading is fascinating because it involves anthropomorphizing the market. When a trader loses significantly more capital than they intended to risk very often because they froze, engaged in perceptual distortion, and became a passive loser, their ego simply cannot handle the sheer weight of the failure.
So they deflect.
They refuse to take responsibility for freezing. So who do they blame? They need a villain. They blame the market. The market took their money. The market stole from them. The market hunted their stop-loss order. The abstract river of numbers suddenly becomes a malicious adversary.
It transforms from a neutral environment into a gladiatorial arena. It's me versus the market. The market insulted me, and now I have to defend my honor.
And if someone stole from you, human nature dictates that you feel compelled to get it back. You demand retribution. So, fueled by anger and adrenaline, you jump right back into the market.
Yeah.
But here's where the psychology gets incredibly insidious.
Okay, lay it on me.
Let's say you lost 20 ticks of profit on the last trade, but your original plan only allowed you to risk 5. You violated your own rules, and now you are down 20. You are furious. You jump back in, and by some stroke of luck, the market moves in your favor by 10 ticks.
Right.
The structural data on the chart is clearly showing that the upward momentum is completely exhausted, and the objective, high-probability, logical decision is to hit sell and take the 10-tick profit. Do you take it?
No, absolutely not, because 10 ticks doesn't make me whole. I lost 20. 10 ticks feels like a slap in the face. I need 20 just to break even and fix my psychological pain. I am demanding the market give me 20.
Exactly. You are entirely blind to the actual market indicators flashing right in front of your eyes. You are no longer trading the market. You are trading your own anger.
Right.
You are demanding the market conform to your emotional need for revenge and restitution.
Wow.
And so, you stubbornly hold out for 20, you ignore the exit signals, the market naturally reverses, and you lose again. Let's analyze the absolute futility of this. You cannot actually get back at the market.
Right. It's not a person.
Exactly. The
Wow.
market is not a person. It has no money of its own. It cannot take your money unless you willingly offer it up, and it simply distributes it to other traders who are on the right side of the force. It is a completely impersonal, emotionless mechanism.
So revenge trading is ultimately just the trader punishing themselves.
Yes.
You are denying yourself a current, valid opportunity to make a perfectly respectable, small profit, purely to punish yourself for a past mistake.
Yeah, that's exactly it.
You are using anger to completely sabotage your own objectivity.
Yeah.
You're punching yourself in the face and yelling at the mirror.
It is entirely self-inflicted damage. And the only way to stop inflicting this damage, the only way to survive the unlimited freedom of the market, is to completely dismantle and rewire the way you think. Which brings us to the most complex and arguably most important phase of Douglas's methodology.
Rewiring the mental environment for success.
Yes.
If the external market is this unstoppable, unstructured, indifferent river, and we cannot control it, cannot predict it with certainty, and cannot seek revenge against it, well, the only thing in the universe we actually have the power to control is our own inner mental environment.
And to control it, we have to deeply understand the nature of that mental environment. Douglas gets a bit philosophical here, but the implications are highly practical. Think about the physical world we inhabit. It is bound by space and time.
Right.
Moments pass linearly. Objects take up physical dimensions. You can't put 2 cars in the same parking spot. But our internal mental environment is non-dimensional and timeless. It operates more like raw energy or light.
Meaning our memories aren't stored like physical files in a cabinet. They are stored as positively or negatively charged emotional energy.
Precisely. A traumatic financial loss or the humiliation of being wrong isn't just a sterile fact recorded in your brain. It is a highly compressed, negatively charged block of emotional energy sitting in your mental space entirely outside of time.
Okay, I follow.
If a current market condition on your screen faintly resembles the pattern that caused that past trauma, your brain immediately triggers that stored energy. You re-experience the paralyzing fear and panic as if the past loss is happening right now, even if the current market context is completely different.
Wow, that's intense.
Your conscious, logical intent to execute a trade is instantly overridden by the massive stored energy of your past unhealed traumas.
This perfectly connects to the story in the text about the man who couldn't run. It illustrates this exact phenomenon. There was a man who decided he wanted to get healthy and start jogging, but his uncle, a man he idolized and was very close to, had died suddenly of a massive heart attack at a young age while exercising.
Yes, The uncle's tragic death created a massive, profoundly negatively charged belief within this man's mental environment. The subconscious equation was permanently written. Strenuous exercise equals sudden death.
So, years later, the nephew decides he wants to run. Consciously, logically, he knows he is healthy. He buys the expensive running shoes. He sets his alarm. He sets the conscious intent. He goes outside. But the very second he starts jogging and his heart rate elevates, he freezes.
He just stops.
He stops dead in his tracks, paralyzed by terror. His conscious intent to run, his logical desire to be healthy, is completely powerless against the internal, negatively charged belief that his elevated heart rate means he is about to die. The mental energy overrode the physical intent.
That is the exact physiological and psychological mechanism that happens to a trader who has spent months backtesting a brilliant strategy, who knows exactly what the system dictates they should do, but finds themselves paralyzed, sweating, unable to click the mouse when the entry signal flashes.
Same thing.
Yes. The internal negative energy of past losses or deep-seated fears of inadequacy is overwhelmingly stronger than the external conscious intent to click buy. To overcome this paralysis, Douglas outlines 3 distinct psychological stages a person must master.
Let's break those down. Perceiving opportunity, executing, and accumulating profits.
Stage 1, perceiving opportunity, requires the ability to make what Douglas calls uncommitted assessments.
What does that mean exactly?
This means you must train yourself to observe the flow of the market objectively, without demanding that it do what you want, and without filtering the data through the lens of your past traumas. You look at the ticks, the volume, the structure, entirely free of fear, simply asking, what is the market trying to tell me?
Okay, that makes sense.
Stage 2 is execution. This means acting on that uncommitted assessment without a microsecond of hesitation or fear. And you can only achieve this if you completely unconditionally trust yourself to execute your stop loss and cut the trade if the market proves your assessment wrong.
The trust isn't that you will be right. The trust is that you will protect yourself when you are wrong.
Exactly.
And that brings us to the third stage, accumulating profits. And this one is fascinating to me, because Douglas argues that your ability to accumulate wealth is regulated entirely by your degree of self-valuation.
This is peeling back the deepest psychological layer. People think the market gives them money. It doesn't. You give yourself the money by acting on the opportunities the market presents.
Wow, okay.
But here is the catch. You will only ever allow yourself to accumulate an amount of money that corresponds directly with what you subconsciously believe you deserve as a human being.
That's deep.
If you harbor deep-seated beliefs that you do not deserve success, if you feel like an imposter, if you carry unresolved guilt or feelings of profound inadequacy, your subconscious mind will view massive financial success as a threat to your identity.
So you'll self-sabotage.
And you will inevitably find a highly creative way to self-sabotage and give all the money back to the market to restore your internal equilibrium.
There's an incredible anecdote in the book about a wealthy floor trader who was doing phenomenally well. He had built up his account by strictly adhering to his rules and consistently taking small, calculated trades of 1 or 2 contracts. But his ego couldn't handle the slow, unglamorous grind.
Right, he got impatient.
He looked around the pit, saw the whales trading massive size, and he wanted to prove to everyone and himself that he had arrived as a big-time elite trader.
So, driven entirely by ego and external validation, he bypassed his risk management rules and scaled up his size massively. He jumped from trading 1 contract to trading massive 20 contract positions.
Which is a huge jump.
Huge. He did this without having developed the requisite psychological infrastructure to handle the exponential increase in emotional pressure and financial risk.
And the result was entirely predictable. He lost nearly $3,000 the very next day. He wiped out weeks of diligent, hard-earned profits in a matter of hours. His account balance simply reflected his chaotic internal state.
Exactly.
It reflected his lack of patience, his unchecked ego, and his fundamental lack of true self-acceptance. He didn't lose because his system failed. He lost because his psychology couldn't support his ambition.
Which leads to one of the most profound realizations in trading psychology. An equity chart, the graph showing the peaks and valleys of a trader's account balance over time, is not just a record of financial transactions. It is a highly accurate, ruthlessly honest psychological map.
Oh, I love that concept.
It visually documents your internal conflicts. It shows your periods of clarity, discipline, and flow as the line goes up, and it brutally exposes your periods of fear, revenge trading, and self-destruction as the line crashes. Your trading results are a direct, real-time feedback mechanism telling you exactly how much you like, trust, and value yourself in any given moment.
It's like your bank account's a mirror. If you wake up, look in the mirror, and you hate the person staring back at you, smashing the glass with your fist doesn't change your reflection. It just leaves you bleeding.
That's a great way to put it.
Getting mad at the market, screaming at the screen, or blaming the algorithms doesn't change your account balance. You have to change the source. You have to change yourself. You have to embrace rigid self-discipline not as a punishment, but as the only tool to build self-trust.
Yeah.
You have to do the psychological work to reach a state where taking a financial loss does not diminish you as a person.
And when you finally reach that state, a miraculous thing happens. The environment ceases to be threatening. And when the environment is no longer perceived as a threat to your survival or your ego, your brain turns off the perceptual distortion.
The fog lifts.
The fog lifts. You can finally see the market clearly, objectively, for exactly what it is.
We have gone on an incredibly deep journey today. We started by examining how the rigid external rules and guardrails of childhood conditioning actively set us up for catastrophic failure in the limitless, unstructured void of the market.
We really covered a lot of ground.
We saw how the illusion of easy money and unlimited leverage creates inflated expectations, turning us into passive losers who just stand paralyzed on the speeding treadmill until it throws us violently through the wall.
We explored the biological neuroscience of perceptual distortion, how our amygdalas literally gaslight our conscious minds by filtering out the data that causes us emotional pain. We analyzed the terrifying herd mentality of the trading floor and saw how highly educated professionals invent absurd superstitions, like fleeing from pennies and urinals just to avoid taking responsibility for their own lack of structure.
And ultimately, we learned that true discipline in any high-stakes arena isn't about finding the perfect mathematical algorithm, and it certainly isn't about trying to aggressively control the external market. It is entirely 100% about controlling yourself. It is about building an unbreakable foundation of self-trust.
It is about fundamentally changing the lens through which you view reality.
Now, to you listening right now, remember what we established at the very beginning of this deep dive. Even if you never open a brokerage account, even if you never trade a single share of stock, a futures contract, or a crypto coin in your entire life, the psychological principles we discussed today are universally applicable.
Totally universally applicable.
If you are an entrepreneur trying to build a business from scratch, if you are an artist staring at a terrifyingly blank canvas, if you're a freelancer navigating the gig economy, you are operating in an environment without external structure.
Right.
To succeed, you have to be the one to define your own boundaries. You have to assume total, uncompromising responsibility for the outcomes. And most importantly, you have to learn how to accept failure and loss without letting it destroy your core self-worth.
The principles of self-trust, objective perception, and internal accountability are the absolute bedrock of any endeavor where you are the sole arbiter of your own success.
So we want to leave you with this final, provocative thought to chew on as you go about your week. Mark Douglas stated that if you operate out of a core belief that anything can happen in the market, the environment ceases to be threatening. Think about your own life right now.
Yeah, think about it.
Where are you currently suffering simply because you are stubbornly demanding that reality conform to your rigid expectations? What would happen tomorrow if you woke up, dropped your demands, made an uncommitted assessment of your life, and simply accepted the raw data the world is trying to show you? Would those muddy diagnostic waters finally clear up?
It is the only way to read the X-ray.
Thanks for joining us on this deep dive. We'll see you next time.